Hello there, this is James, and you're watching Tixee Live. In fact, you're watching a Tixee Live watch-along of the US CPI, Consumer Price Index, the last CPI reading of 2022. Now, before we start getting all into it and start building it up and go through some scenarios and have a little bit more detailed conversation about it. And then, of course, watch the event unfold. Don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, there are the risks at hand before entering any trade. With that out of the way, let's get started. That's a good one, wasn't it? Right, so like I said, this is indeed Tixee Live watch along of the US CPI. I saw this comment as I was coming on. Brilliant. I know everybody likes a good old watch along. It's good to see you. So, so like I say, this is the last US inflation. This is going to be the last one of 2022. And here's the thing, the US inflation has been the number one market mover over the last couple of months. In fact, the previous king of Forex indicators was the non-farm payroll. Those of you who watch me do watch-alongs of the NFP, I used to talk about the days when the NFP was such a big deal. It still causes volatility, but to be fair, over the last couple of months or so, well, good majority of this year, it has been overshadowed by the CPI. But for those of you who are new to trading and just starting out, you want to know what CPI is, or Consumer Price Index is, and why is it so important to the market or to traders? Well, in a nutshell, the Consumer Price Index, registers the change in the price of goods and services purchased by consumers, purchased by you and me. In other words, it's inflation. It's inflation. And we all absolutely know, we've had a massive battle on our hands against inflation. We really have. And inflation's been trading around a 40-year high across the board with so many nations. So it's been an absolute fight against it. And the reason why it counts so much to traders or to the market in general when they look at it is because inflation has an impact on a currency's value, As rising prices or rising inflation leads to central banks to raise interest rates to contain it, And we all know that the market has been absolutely obsessed with, obviously, inflation, but with also the reaction or the thing by, what a great year we're having. It's been a massive year this year. It's been incredibly volatile. Ever since I've been doing Tixee Live, and this is my 310th episode, I think. There's been so many stories happening in, 320, sorry. So many stories, but, to talk about, it's untrue. But yeah, it's been a hell of a year. Totally good to see you as well. But yeah, anyway, we've been obsessed with, obviously, the central bank's attack or fight against inflation, raising interest rates. Now, they've been needing to raise interest rates to try and calm inflation. And the Fed in particular, because it's about this, the US today, so it's all going to be focused on the Fed. The Fed has been incredibly aggressive. Certainly of the last 4 interest rate decisions, they've done 75 basis points. Their interest rates now is around 4%. And the reason why today is almost like a perfect storm, because tomorrow, we get the Fed interest rate decision. So whatever, so the question is, will the rate, whatever happens today, will that alter their decision on what they're going to do tomorrow? And this is where the market is obsessed with it, can't wait for it, excited, watching it with bated breath like I am. The question for me is, I don't think it's going to change no matter what the reading is today. No matter what the reading is today, I don't think it's going to change the outcome, which we all pretty much priced in. And we're pretty much expecting 50 basis points tomorrow. However, depending on the reading, if it's a lot higher than anticipated, then the market might suddenly think, okay, we know what they're likely to do tomorrow, but what they're going to do in February? Are they going to do 50 basis points in February, because the market was hoping, with certain data coming through, that the Fed might start being gentle and only do 25 in February. But if we get a hotter than anticipated reading, then the bets are going to be on maybe for another 50 in February. Okay, so this is what the market, and don't forget, the big institutions, they don't look at what's happening today or tomorrow. They look what's happening in a couple of months' time or a year's time. So this is what they look at it. Okay, so they're going to be looking at that. Now, let's have a look at what the expectation is. Now, don't forget, we have two types of inflation readings. First of all, we have the consumer price index year on year, which is the headline. Expectation for this is coming lower than anticipated at 7.3%. Previous reading was 7.7. Okay, core price index year on year. Now, remember the difference between the two. Headline, which I call year on year, or the headline rate, it counts into energies and food in its calculation. Core doesn't take into account energy and food. It focuses more on the durable goods like clothing, rent, which is a big deal. Like I said this morning, rent is a massive deal. So they look at rent and things of this nature. Now, anyway, core is a big thing. Okay, I think it's more important. But either way, the headline rate, or the first one gets all the headlines. But I think the core is important for decisions to come in the future. Expectation is to come in at 6.1%. Previous reading was 6.3. Month on month, which is the change month on month, obviously. Okay. Headline is 0.3%. Previous number is 0.4. Core CPI year on year expectation is 0.3. Previous 0.3. So they're expecting the same reading. Other central banks are looking at the same. Societe Generale expecting 0.3 for both core and headline. Deutsche Bank expects 0.21, so just below 0.3, and 0.27 for core, so just below 0.3 again. Citibank predicts 0.3 month on month and 6% year on year. Wells Fargo 0.2, headline 7.2, so pretty much the same. So the question is, what we're going to be looking at with this, why this is so important, is are we finally going to see the Fed making some progress with all their aggressive rate hikes? Are we finally going to see them making progress? You know, we're not seeing massive progress in the labor market, because don't forget, they need to bring the labor market down as well. But that is not, after the last NFP number, is not cooling down either. So are we going to see something which says, at last, the Fed is making progress? Now, let's go through some scenarios. Scenario one, comes in lower than expected, say month on month, 0.2. USD tumbles, and there's much rejoicing for stocks because they are making an impact. Potential scenario number two, comes in as expected. There's still a little bit of rejoicing, but for stocks, and USD declines, but then stabilizes as the fight's still on, as we still got plenty of room to go. Scenario number three comes in slightly higher than expected. So not that high, it's beginning to move already. Dollar positive, but it's medium-lived. And then scenario four comes in a lot higher than anticipated. Market panics as the Fed will do 50 in February. But anyway, let's get to it. First of all, I'm going to have a look at gold. Okay, because we've got 3 seconds to go. 3 seconds to go. Right. This I'm going to be fascinated to watch. Okay. Oh, look at that. Goes short, straight up. Straight up. So that's a key level as well. Massive move there. Massive. What is it? That is a massive spike up. This has got to be good news for the market. Come on, what is it? Okay, hang on. Right. Year on year headline rate is, what is the year on? Look at that move on gold. Look at that move. 7.1 year on year. So lower than 7.3. So better than anticipated. That's good. Core year on year. What did that come in as? Core came in as. What did core come in as? Come on. 6%. So lower than 6.1. Again, good news. Means they're getting slowly but surely on top of it. Month on month. Headline rate, what was it? Month on month. This is the important one. This and the core month on month. This is key. 0.1%, lot less than expected. They expected 0.3, 0.1. Amazing. Right, core, month on month. This is key. 0.2. 0.2. So it comes in lower than anticipated, a lot lower in many ways. Not the core so much, but the headline did. So it comes in lower than anticipated. Right, so as you can see, gold straight away, challenging the $1,803. Lovely spike there. Let's look at the S&P 500 as well. There's much rejoicing in the market as well. Much rejoicing. The market, there's much rejoicing. Spiked above the 200-day moving average as well. Yes, it is my favorite. Yes, I'm a gold bug. Right, above the 200-day moving average. A lot better than anticipated. Very good. Right, euro over the 106 handle. 106 handle. Let's have a look at this move. What a lovely move. Remember, we will be watching this level for a while. It's not saying it's gonna stay above that as of yet. It's challenging it right now. 1.0616. Brilliant. Euro sterling 124 above the 124 handle. Now that's a huge move. Bear in mind, we've been challenging or trying to keep above the 123 handle. Amazing. Let's go back to look at the S&P as there is much rejoicing. Much rejoicing in the S&P. Much rejoicing. This is big. So basically, this potentially means maybe, just maybe, yes, we've seen the peak, which we'd already anticipated. We've seen the peak. But now we're beginning to see them get on top of it, which then means, okay, we're still going to get 50 tomorrow. Let's not kid ourselves. We'll most likely get 50 basic points from the Fed tomorrow. But means come February, they may be more gentle. They may do 25 because it looks like at last they're finally making progress. Well, it does mean that bit by bit, what they're doing is beginning to cool it down. I mean, look, we've got a long fight on our hands. So though there's much rejoicing at the moment, we're still a long way away because like I just said, the headline was still 0.7. Okay, 0.7%. So it's better than anticipated. They were expecting 7.1 it came in at. A lot better than anticipated. Okay, a lot better. But targets two. So we've still got a long way to go. A very long way to go. So, but look, it's beginning to make a dent. So that has got to be market positive for now. It really has. It really has got to be slightly more. As we can see from the initial reaction, is market positive. Market positive. I'm not sure if we can still maintain this momentum above this level, though. But we'll have to see. But there we go. There we go. See the CPI. I told you the CPI at the moment. That's the last reading. Last reading of 2022. 7.1 year on year. What was it again for month on month? Month on month was 0.1, a lot better month on month. So don't forget, those two are greatly impacted. This is the thing as well. We've got to look underneath the hood, okay? Don't forget, they've got to look under the hood, the month on month, okay, 0.1. Oops, 0.1, right? Year on year, it was 7.1, wasn't it? Okay, so that's impressive. But before we get the total bunting out, they take into energy prices. And don't forget, we've had oils come under pressure. The core doesn't. And the core, though month on month is better at 0.2, it's still got a bit of way to go. When was the last time? Actually, the core month on month hasn't been 0.2 for a while. So that's quite encouraging. Year on year, though, again, it's 6. Came in at 6%, didn't it? Last time it was 6 was May. So again, slight improvement, but the core is not, and we've had lower energy prices. So we've got to take that into account as well. We've got to bear that in mind. So anyway, better for the market, not so good for the dollar at the moment. Like I said, I think we got to look under the hood. So we need to take a while to digest this. Again, because let's say the headline sounds a bit more impressive. The core is better, but we're still trading pretty much around year on year where we were June and July time. The month on month is encouraging, though. This is the core I'm talking about, because we haven't been at 0.2 all year for the core. Closest we've been is 0.3 last month. So that's encouraging. But again, we have to look at the hook. Look under the bonnet. I'm English. We say bonnets, of course, obviously, not hood. So we have to look under the bonnet. So anyway, for now, there we go. What a move. What a move. Great CPI to finish, US CPI to end the year with. Really, really good. We've still got the UK CPI. Not that that's going to drive the market. But again, like I say, with this result, will the market now start thinking in February, we're only going to get 25. We ain't going to get 50. 50 is, no doubt we're definitely going to have 50 tomorrow. So that won't change anything. But anyway, much rejoicing for now. Let's have a look at the bonnet. I don't think let's have a look at the S&P again as well, because like I say, we still are challenging that low at that level. Brilliant move, but we haven't broken that key level for gold as of yet. S&P, more importantly, under it's 200-day moving average. It's just above it on a daily, but like I say, we haven't broken and stayed above it as of yet. So much rejoicing in the short term. Let's see after we have digested everything. But there we have it. There we have it. The watch along. So, was anyone else surprised? You surprised by that? What do you think? What's everybody else's opinions on this? How do everybody else see it? Thanks, James. Oh, that's nice. You're welcome. You're welcome. My phone's buzzing now with all the stuff. But anyway, look, that is encouraging. Don't forget, you can ask me questions anytime at all, or simply share with me your opinions or your ideas or what you think. Yeah, well, like I say, this is it. This is again, depending on your trading style, this is where you need to be cautious. I always say you need to be cautious in trading so you don't get carried away. If you're patient, like I am, then you read under the bonnet first. But again, it depends on your trading style. It really does. But like I say, the initial reaction has been obviously bullish. The market is taking this as good news. But like I say, S&P hasn't stayed but it's not, we need to clear the 200-day moving average. Gold still needs to really stay above or break cleanly that key area for me. And euro dollar as well. We will have to keep the same eye on that, and same with the cable as well. Let's have a look at the dollar yen, actually, see what the dollar yen. Actually, you can't see my chart, can you? I forgot I'd taken it off. Look at the dollar yen. See, that was a nice drop down as well. It's a dollar weakness initially against the yen. Okay, so really now we're looking at potential area of interest for the dollar yen, 135.05, which is the 200-day moving average on the daily. So keep an eye on that. Okie doke. Okie doke. Don't forget, if you think of a question later, you can put it in the comment section, either on YouTube or Facebook. I will see them and I will reply to them next time I go live on air, which of course will be later this afternoon to cover the US session. I'll do a review of this. Plus, it gives a bit of time to see how the markets react, to see how the US market opens to this as well, and any other breaking stories. So please come and join me for that. If there is no questions, not a problem. Not a problem. Like I always say, if you're watching me on Facebook and you enjoyed this little video, by all means, give us a follow. If you're watching me on YouTube and you enjoyed this little video, subscribe if you like. Hit the notification button so you know next time I'm going live. If you enjoyed this video, found it interesting, useful, and exciting like I do, and you've put up with me, my over-the-top enthusiasm for the markets, I simply cannot help, then give me one of these. It's nice to know that you like what I do. Anywho, till next time, don't forget, these little videos are for educational purposes only. And in no way whatsoever should be in no way taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand for entering any trade. Till next time, every single one of you, trade safe.